In this video, we're going to look at drawing support and resistance lines and how it varies between different market types. Stay tuned. Hey traders and investors, a very warm welcome to you. So one for swing traders, investors and scalpers here. Very key, important kind of foundational thing for traders, drawing our support and resistance levels lines, whether you're using a 1 minute chart, 15-minute, daily, weekly, monthly, doesn't matter. The concept is the same. However, the problem that I see a lot of traders having, and a problem that I kind of noticed myself doing a while ago early on in my career, and I thought, you know what, this actually is fundamentally changing the way I trade, was how I drew my support and resistance lines. So I'm going to bring up Euro US dollar now, and let's just clear off those lines for now, and we can start from scratch. Daily chart, Euro US dollar, we're all familiar with this. We kind of want to draw our support and resistance lines because support and resistance lines are levels that we are looking to potentially do business, right? They're levels that the supply-demand balance could shift or could accelerate. Well, they're going to break through or we're going to fade. Now, we're not going to go into this video specifically whether we're looking to fade or we're looking to buy a breakout or sell a breakout. All we're looking now is to define these support and resistance levels and how we can better do that to improve our trading. Okay, so one thing that a lot of traders do is they say to themselves, all right, I'm going to draw a support and resistance line here. Now, just eyeballing this chart, we can see we've got a support down here. Now, some traders are going to say, well, actually, this is the support here because that's the lowest of the low there, and we had a low here. That should be the support. Other traders are going to say, no, it's got to be this level here, you know, and we get this kind of mismatch of lines. You've got lines all over the place, and then someone else is saying, oh yeah, but there's another little line here, and you kind of get a little bit of a mess, right? And some people have minor support, major support, different color lines, and for me it just gets so messy and just so kind of grubby. So the solution that I have, which works quite well for me, is that I say to myself, okay, well, you know what I'm going to do? I'm going to consider this as a support box. Now, I may draw a line on there because sometimes I don't like to have this so in my face, but you can kind of change the settings on it. If you're using TradingView, you can change the settings. If you're using other thing, you can reduce the border and just have it as a clear box, so to speak, with just an outline. But the idea of this is, hey, the market is coming into a zone that I'm interested in, whether I'm interested in to fade it or break out. I don't have to feel so panicked or so kind of alert just because one finite line has been tagged. The trouble you have when you're drawing a support line like this is that it's basically 1 pip wide or a couple of pips wide depending on, you know, thickness of the line, and you almost get to a point where if the price doesn't quite get to it, you kind of say to yourself, well, what do I do? You know, the price is getting here. Should I be if I'm looking for, let's say I'm looking to fade the support level and go long, do I buy it now or do I wait to a touch? Do I, you know, how do I structure my trade? Whereas if you have a rectangle like this, whether you use a rectangle, however you draw it, some kind of fuzzy zone of interest, you interpret it differently. It changes your frame of mind. You kind of look at it and you say, well, do you know what? This is an area, we're getting close to an area. I need to be aware of it. I need to be kind of looking for some kind of signal, candlestick signal, some kind of momentum signal, something. We're in the zone. And it just changes the way it's framed in your mind. I can't really explain unless you try it out for yourself, try it out for a little bit. Use this kind of strategy instead of the line. Like here, for example, we might say, well, you know, there's a key block of level that I'm looking to do business. Now, you know, you could have quite a wide range of lines if you're drawing lines, but the rectangle allows you to think a little bit differently and say, well, if that's a target for my trade, we're approaching the rectangle, maybe I can scale out into it. Maybe I scale into a trade if I'm fading that level. If we break right through the rectangle, how do I deal with that? You know, if you just had a solid line here, you would say, well, that's broken. If I had that rectangle, get rid of that, and I looked at the solid line here, which is quite a sensible level to put support, and we broke through here, I might consider that as a break. Whereas in actual fact, really, I should be looking at the bigger picture and saying, well, it's a cluster of areas. Now, sometimes we do get a tag to a key level and we pull back almost to the tick. But more often than not, we get this cluster of support, cluster resistance, cluster of price turning point, where we need to be alert and aware of what's going on and give ourselves a bit of flexibility within it. Give ourselves an area where we can look a little bit deeper. We don't have to feel so panicked because it's broken through the resistance, because we just frame the way we look at it differently when we see price above or below a line. Oh, it's not quite hit the support yet. Oh, it's through the support yet. When in reality, we've got a rectangle, we're like, okay, we are in the support area. It just changes the way you look at it, changes the way you frame it, and creates less urgency and allows you to, get in tune with the market environment as well. Because one final thing, guys, before I go, is this width of the rectangle is going to be quite telling. If you have like a wide support level like we have, for example, here, the argument could be that we've got two, but let's say we have that and we're kind of extending it, which is what we normally do when we do support resistance, right? We get our levels of interest and then we extend them out to see if they're going to hold in the future. And in this case, they do. So what it allows us to do is allows us to see, hey, this is quite wide, these rectangles. I can't really be using a tight stop. If you were going along here and using a tight stop, you'd be out. But in reality, it's still kind of within the level that you were looking at. So it allows you to adjust your stops as well. You're saying, hey, listen, the last kind of 5 months, 6 months, whatever it is, or if I'm trading on a 1 minute chart, 3 minute chart, whatever the time frame is, the rectangles have been quite wide. The support's been almost a bit grubby. So we've broken through kind of 10, 15 ticks. We've hit it sometimes. We've fell short, but ultimately it's still kept in that area. That allows me to refine my trading strategy a little bit more and say, okay, I need to be a little bit wider with my stops. I can't be so finite. I can't be so strict with them. I need to be a little bit wider. I need to perhaps scale in to give me a bit of an average entry. I need to allow and adjust my trading strategy to accommodate the market conditions. And of course, on the flip side, if we've got really narrow boxes, let's say for whatever reason we've got really, really narrow boxes. Let's go back kind of for here. And this is a reasonable example. Let's get the rectangle back out. Let's say here, okay, we've got a narrow box which isn't so wide, and we can say, well, actually, you know what, that's a little bit better, that's a little bit tighter, that's a little bit, we can perhaps use different strategies in that. We can go a little bit more aggressive and a tighter stop, whereas if we've got a wider box, we're going to have to use a wider stop and accommodate the fact that the market conditions are a little bit different. So actually, I said it was the last thing, but I just want to mention this. If we're trading FX pairs, we're going to get a lot more wicks and stuff on a daily chart because of the 24-hour market. If we're trading stuff like the Dow, the DAX, and stocks, we're not going to get as many wicks because of the limited hours are open compared to FX. So you're more likely to get finite levels. So again, a useful little tool to use, like the rectangle tool or however you want to frame it, when you're trading different markets, to allow for different conditions, to one, allow you to see the kind of nature of the market and get yourself more in the flow and in tune with it. Two, to be a little bit more flexible with your stops, and three, to be a little bit more flexible with your entries as well. Understand that it's a zone rather than a finite level. Sometimes it will be a finite level, but sometimes it's going to be a zone. Anyways, I hope that's helped somewhat, and give it a thumbs up if you like it. See you in the next one. Take care. Bye bye.